So let's dive into the snapshot of Alphabet's performance in Q2 2025. What a ride, right? We're seeing really strong revenue growth, with Q2 revenue hitting around $96.4 billion.
Yeah, absolutely.
And it's interesting how the mix is playing out. Google services, including search, YouTube ads, subscriptions, and devices, delivered roughly 82.5 billion, while Google Cloud posted an impressive $13.6 billion, up 32% with positive operating income.
That's notable. What really grabs my attention is how the operating margin sits at 32.4% and EPS at $2.31. That's a solid performance across the board, right?
Definitely, yep. And then you have CapEx. They're planning around $85 billion this year to fuel AI infrastructure. It's like it's like they're betting big on scaling AI while still delivering free cash flow around $66.7 billion.
Yeah, I get that.
And don't forget the share repurchases, a fresh 70 billion authorization announced in April. So they're really signaling long-term confidence.
Right, absolutely. But here's where it gets tricky. Regulatory pressure in the US and UK. We're hearing about remedy discussions in the DOJ search case and a strategic market status designation in the UK for search ads, correct?
Exactly. It's one of those near-term overhangs. I mean, the regulatory landscape is tightening, and while Alphabet's pricing power and payout capacity are strong, these issues could throw a wrench in the works if not handled properly.
That's a fair point.
Speaking of strategy, what's really fascinating is their dual flywheel here. On one hand, the robust core services like Search and YouTube really generate durable cash flows. Then that cash is reinvested to grow Google Cloud profitably while building out AI capabilities.
Yeah, it's kind of like reinvesting your earnings into a high octane engine for future growth. Right, but wouldn't you say the AI monetization plays a critical role? I mean, they need those AI driven revenue lifts to exceed the increased compute and power costs, the so called search answer cost curve.
Yeah, exactly. You've got this equation, lift RPM versus the compute cost per query, CAAI, and power price. The game here is to achieve efficiency gains through custom silicon. Otherwise, margins might dip.
I see where you're coming from.
And then there's the cloud side. Strong leverage here. Q2 showed cloud adding roughly 1.65 billion of operating income on about 3.3 billion in revenue growth, which basically means an incremental margin of around 50%.
Wow, that's impressive. Yet I'd respectfully challenge that point. Can cloud maintain those margins as AI integration scales? There might be some margin pressure as deal mixes shift between training and inference workloads.
Fair critique. And yeah, it's definitely something to watch. Alongside that, the overall emphasis on monitoring CapEx productivity, data center efficiency and depreciation cadence, is critical as revenue uplifts come in.
Yeah, I'm with you on that.
And the risks? Well, we have regulatory uncertainties, potential AI cost absorption issues, and some macro and FX sensitivity that could tug at advertiser budgets.
Those are real risks.
Bottom line, Alphabet's executing a dual flywheel. Services funds the AI and cloud ramp up, and a strengthened cloud business supports the evolving search business. As long as AI monetization scales properly, the long-term compounding looks favorable despite the headwinds.
Right, it's a compelling setup with smart reinvestments and a strong cash generation backstop.
It's a dynamic balance with continuous innovation and careful management of capex and regulatory risks. Alphabet appears ready to ride these waves, consistently powering ahead.
Absolutely, it's going to be interesting to see how this evolves.